There's a quote that says, "Love me or hate me, but you can't ignore me." And it fits beautifully for Zomato. What started as a simple website that listed restaurants and cafe menu card has today become a mammoth 2 lakh crore plus market cap company and would be now part of prestigious Nifty 50 list that include top 50 companies of India. Last time I discussed Zomato in detail was during its IPO in 2021, and what a roller coaster ride it has been for the company. I clearly remember it was the peak of bull run in India, and Zomato IPO received a stellar response with 38 times subscription. Stock also had a dream rally where its IPO price was around 76 rupee and got listed at 116. It kept on going up and touched an all-time high of 169 rupee within a few months of its listing. But then it started facing headwinds, and over the next 14 months, Zomato's stock price crashed to levels of Rs 40. But from those lows, it again rose like a phoenix and zoomed 6 times over the next 2 years to touch highs of Rs 300. And today, stock has again fallen 25% from the peak. Even today, Zomato is one of the most discussed stock in the market where public opinion is completely divided. Some believe that Zomato would still have a long way to go and create wealth for the investors, whereas some argue that Zomato is overvalued and a hype story. In fact, even the market experts are divided on Zomato valuation and future prospects. In any case, it is a fact that Zomato today has more than 25 lakh shareholders. Even if you are not an investor, there's a high probability that you are its customer and using its Zomato app for food delivery or Blinkit for household grocery. So I thought of sharing my viewpoint on Zomato in detail. I have divided this video in 4 parts. First, we will discuss its IPO journey with rise and fall. Then we'll discuss Zomato rise like a phoenix with quick commerce. Third topic would be the SWOT analysis of Zomato. That would include its key strength, weakness, opportunity and threat. And finally, we'll discuss the most debatable topic, that is, are Zomato valuations justified and is it worth investing even at current levels? But before we proceed, this video is only to share my viewpoint on the company. I'm a SEBI registered research analyst, so technically I can give buy or sell calls. But I strongly believe that if a person wants to create wealth in the stock market, he or she must study the business. Because it's very easy to buy a company when the share price is rising. The most difficult part is to decide what to do when the share price is falling. And most people who invest without knowledge end up selling the stock when the share price is falling. Because they simply don't have the conviction. And that conviction only comes with knowledge. If you don't have enough time for research, I would suggest investing via mutual fund route. Or if you still want to invest some money in direct stocks and need guidance, you can explore my weekly video series where I share my own investment strategies and closely tracking more than 200 companies and their quarterly results that I record in an Excel tracker. I recently shared my portfolio details after this correction. For more details, you can explore my website or explore the join button of this YouTube channel. Alright, let's get started. When Zomato launched its IPO in July 21, it had already pivoted its business model from just a menu card listing platform to India's largest online food delivery company that disrupted the way people consume outside food. You could order food online with just a few clicks, and that too within 30-40 minutes. Zomato gained a massive market in metro and tier 1 cities where people preferred convenience. This was reflected in company's revenue growth that zoomed from 466 crore in 2018 to 1300 crore in 2019 and then 2600 crore in 2020. That's a 5.5 times growth within 2 years. The key narrative was Zomato has just scratched the online food delivery market of India. There's a lot of growth potential in tier 2, 3 cities of India. As a result, Zomato listed its IPO at 76 rupee, valuing the company at a market cap of 60,000 crore rupees. Since it was also the period of bull run in Indian stock market, Zomato received a stellar response and company got listed at 116 rupee. Stock kept on rising for next few months and touched highs of 169 rupee in November 21. At that time, Zomato market cap zoomed to 1.3 lakh crore rupees. However, there was one catch. Zomato was still a loss-making company. In fact, its losses kept on widening from 100 crore in 2020 to more than 2000 crore. But management always guided that losses are due to company's massive expansion plans to capture the market. Company intend to become profitable in the near term. But then 2021 was the year that witnessed a sharp fall in Zomato revenue growth. Mind you, Zomato was still loss-making in 2021, although net losses narrowed down significantly. So fall in revenue growth in 2021 coupled with losses created doubts on Zomato's future and its path to profitability. And remember that during that time, Zomato was commanding a market cap of more than 1 lakh crore rupees for sales of just 2000 crore rupees. That translated to market cap to sales of more than 50 times. Obviously, those were unsustainable levels, and P/E ratio could not be even calculated as Zomato was in losses. As a result, Street turned negative on Zomato and its share price kept on falling. People started comparing Zomato with tomatoes, and Zomato share price fell down 75% from the peak of 169 in November 21 to levels of 40 rupee by January 23. But then something extraordinary happened that resulted in exponential growth in Zomato business and its share price. Let's understand it. While Zomato was struggling between 2021 and 2022 and its share price was falling, company's management took a very bold decision. In August 22, Zomato acquired Blinkit for 4,447 crore and that sparked a lot of controversy. During that time, Zomato was already struggling with growth and was still loss-making. Yet it acquired Blinkit for massive more than 4,400 crore, which was again a loss-making company that time. Investors started questioning the future of Zomato and hence the share price kept on falling. But eventually, it turned out to be a master stroke by Dipinder Goyal. Acquisition of Blinkit gave Zomato an entry into the quick commerce industry that turned out to be the biggest growth engine for the company and the reason behind exponential rise in its market cap. Actually, the food delivery business was great, but it had a limited market. While initial few years resulted in exponential growth due to fast adoption in metro and tier 1 cities, and of course the discounts and everything, but then the growth started slowing down when the adoption became slow in tier 2 and 3 cities. And that's where Blinkit opened a whole new world for Zomato with quick commerce business that offered household item within 10 minutes. Now that expanded the TAM, that is total addressable market for Zomato, because this time Blinkit received a stellar response and the market size was huge. It literally changed the consumer habit because now consumers are getting everything at their doorsteps within 10 minutes. Plus, the order frequency was much more than what it was for your food delivery. You can order food once in a while, but household grocery and other items are required every single day. As a result, Zomato again witnessed a sharp jump in revenue growth from 2,000 crore in 2021 to now at nearly 18,000 crore. Not only that, company also turned EBITDA positive in 2024 and that further instilled investors' confidence in management's promise to make Zomato an profitable entity. As a result, Zomato share price zoomed from January 23 lows of 40 rupee to touch levels of 300 rupee and its market cap touched highs of nearly 3 lakh crore. But recently, Zomato share price has corrected around 25% from the peak. The reason for this correction is concern over profitability. In the latest quarterly result, Zomato registered revenue growth of 64% year-on-year, EBITDA growth of 214% year-on-year, but net profits have fallen 57% year-on-year. And the key reason is rising competition. Today, Blinkit is facing stiff competition from other established players like Swiggy, Instamart and Zepto. Plus, Tata is aggressively foraying into quick commerce with Big Basket. Then Flipkart has already launched its quick commerce platform Minutes. Likewise, Amazon is already doing pilot phase for its quick commerce platform Tej. So on one side, quick commerce is definitely a very high growth sector in India. Competition is really getting intensified for Zomato's Blinkit. As a result, Zomato path to profitable growth has been pushed forward. Earlier, Blinkit targeted 2,000 dark stores by December 26, but with rising competition, Blinkit has pushed forward its 2,000 dark stores target to December 25. There was a question on do you expect losses to continue in the near term? And management said, yes, we do. As we continue to bring forward store expansion, our network may have to carry a greater load of underutilized stores, which will impact near-term profits in the next 1 or 2 quarters. So due to delay in Blinkit's path to profitability, Street was a bit disappointed and that resulted in 25% correction in Zomato share price recently. Now before we get into the valuation part, let us have a quick look at Zomato's SWOT analysis. The biggest strength for Zomato is its market leadership in both food delivery and quick commerce business. As of today, Zomato enjoys 58% market share in Indian online food delivery and remaining market is with Swiggy mainly. However, the high growth area is quick commerce where Blinkit currently holds 46% market share followed with Zepto and then Swiggy. Second strength is strong brand position. Zomato food delivery app and Blinkit both have become a trusted household brand in India with its very user-friendly app, extensive delivery network, and very reliable service. And brand building in consumer business is one of the most difficult tasks. Third strength for Zomato is exceptional leadership team. Zomato is led by Mr. Dipinder Goyal, who is an IIT graduate and has an excellent understanding of technology. So the tech behind Zomato business is excellent. That include providing personalized recommendation, real-time order tracking, online payment, and so on. Plus, Dipinder Goyal is young and hungry for growth. So that augurs well for company's future growth. Fourth strength of the company is diversified business model. Company is not just into food delivery and quick commerce. It also has its presence in B2B segment via Hyperpure, where it supplies high quality ingredient and kitchen products to restaurant partners. Then Zomato has recently forayed into event planning with its brand District. Last year, Zomato acquired Paytm ticketing business for 2048 crore and rebranded it to District. So that can also be another growth engine for the company. As far as weakness is concerned, one of the weaknesses is their path to profitability. At this point, company is burning a lot of cash to offer discounts and attract customers. Now, personally for me, there is no differentiation between Blinkit, Zepto or Instamart. As a customer, I would be happy to order products where I get the maximum discount. I have all three apps on my phone. While this quick commerce is certainly a massive market and there is ample scope for growth for all the companies, I have doubt about customer loyalty on why someone should use Zomato or Blinkit only. And that can be a challenge for profitability. Because if competitors are giving heavy discount, Zomato will have problem with that. Second weakness is operational challenge. Zomato has a complex business and it's not easy to manage such a massive delivery team. Rider retention is one key problem. Then quality control, order delays are other few challenges. So it's not an easy business to operate. Now, if you look at the opportunities, first biggest opportunity is exponential growth potential in quick commerce industry. Quick commerce has certainly emerged as a very fast growing industry in India and this exponential growth should continue for next few years. Interestingly, quick commerce that started with selling groceries is already expanding its offering to include cosmetics, electronics, household item and so on. And there can be further new additions as well in the future. And it is directly challenging the e-commerce industry. Blinkit is an undisputed leader in this space today with 46% market share. And Blinkit expect to continue to grow its GOV, that is gross order value, by more than 100% in FY25 and FY26. Second opportunity is decent growth in online food delivery industry. Although online food delivery market growth won't be exponential, but there is still enough room for growth in this industry as more and more people adapt online food delivery options. Then third opportunity is the growth of live events. Of late, the craze for live events in India has gone crazy. This was clearly visible from demand for Coldplay and Diljit show tickets in India. And going forward, live events can be a big industry. Although there are already established players in the segment like Book My Show, Zomato with its District app has good potential to grow in this space. Not only that, Zomato is trying a lot of other things. For instance, recently they launched an app Bistro that would deliver food within 10 minutes. It mainly includes your snacks, quick meals and beverage. So company is trying to identify multiple sources of revenue and increase its TAM size. Finally, if you look at the threat, the biggest threat in my opinion is cutthroat competition. Zomato certainly has got the first mover advantage in both online food delivery and quick commerce segment, but the competition in quick commerce industry is getting intensified with massive spending from Swiggy, Instamart and Zepto. Plus, Tata is aggressively foraying into quick commerce with Big Basket. Then India's e-commerce giant Flipkart and Amazon are already ready to take over the quick commerce industry with their platform Minutes and Tej respectively. In short, it is not going to be easy for Zomato to grow at a rapid rate along with maintaining a good profit margin. So that's the biggest threat. Now let us finally discuss the valuation part. Today the entire investor community is divided over Zomato valuation. Some says that Zomato should command a high valuation for its growth potential, whereas some people are cautious of current valuation with respect to increasing competition in the industry and lack of profitability. And honestly, it's not an easy task to gauge Zomato valuation. I mean, you can't look at PE ratio as it is barely profitable and today PE is showing more than 300. Plus the kind of disruption happening in the industry, it's a futile exercise to do the DCF analysis. So near-term valuation of Zomato would totally depend upon its execution and market sentiments. Since the Q3 results were disappointing in terms of profitability, Macquarie slashed its target price to 130 rupee. Jefferies also downgraded Zomato to hold from buy, cutting its target to 275 from 335 earlier. However, some brokerages remained optimistic. Bernstein held on outperformance rating with 335 rupees target, and Morgan Stanley maintained overweight at 355 rupee. Now, if you ask me, I believe that if Zomato continues to grow at a fast rate, market sentiments would remain positive in the near to mid-term and Zomato should do reasonably well. However, if you ask my long-term viewpoint, I believe that a majority of future earning growth is already discounted in Zomato's current valuation. Here I'd like to share one of the theses from industry veteran Mr. Manish Chokhani, and I completely agree with this viewpoint. He says that if Zomato continues to compound investor wealth at 20% rate, in next 10 years it would command a market cap of around 13 lakh crore. If it compound investor wealth at 15% rate, in next 10 years it would command a market cap of 9 lakh crore. Now today, market is giving it a premium because there's a massive growth potential. But 10 years down the line, Zomato growth would normalize. In that case, its fair PE should be around 30. Now how did I consider a fair PE of 30 after 10 years? Well, that is debatable. You can give a PE of 40, 50, anything you like. But mature business usually command a fair PE of 30. I mean, you can look at companies like TCS, Infosys that also command similar PE. But again, you can also consider a PE of 40, 50 based on what you like. Now in that case, after 10 years for Zomato to command a market cap of 13 lakh crore at a PE of 30, it should report a net profit of 43,300 crore. Assuming PE of 40, it should report a net profit of 32,500 crore. At 15% compounding with 30 PE multiple in 10 years, Zomato should report net profit of 30,000 crore, and at 40 PE multiple, net profit should be 22,500 crore. Today, Zomato net profit is around 663 crore. Can Zomato grow the profits to such massive level? Maybe. But considering the growing competitive intensity, I find it extremely challenging. Recently, Zomato has changed its listing name to Eternal. I hope it does not take eternity for Zomato to create that kind of profitability. So from current levels, we are not even considering massive return. Even 15 to 20% CAGR return for next 10 years are difficult for Zomato. That is the reason I said that majority of future earning growth is already discounted in its valuation. And I find it expensive as a long-term investor. It may go up or down in the near term based on results, execution and sentiments, but long-term wealth creation from current levels, even at 15 to 20% CAGR rate, is going to be very difficult in my opinion. I mean, just for comparison, look at the wealth creation from Titan that also has similar market cap like Zomato. But Titan is nearly a 300 bagger company in last 20 years. And the reason is because 20 years ago, Titan commanded a market cap of just 1,000 crore rupees. Zomato is already a 2.2 lakh crore company because the majority of 100 to 200 times growth is already enjoyed by early investors in the company. Now retail investors are left with hardly 2 to 3 times growth over the next 10 years. That too is going to be difficult. Again, this is my analysis for long term. I may be wrong. So in this video, we discussed the journey of Zomato from its listing till today. Then we did the SWOT analysis of the company, and finally we discussed the valuation. If I quickly summarize, there is no doubt that the opportunity size is big with quick commerce business. However, competition is going to be a key threat for Zomato. Going forward, in the near to medium term, its share price movement would depend upon various factors like Blinkit's growth, competition, then profitability would also be a very important criteria. And finally, of course, the market sentiments. If Zomato can maintain its market leadership, improve profitability and adapt to changing consumer preference, it can continue to do well in near to medium term. Any failure to achieve these parameters would result in derating. As far as long-term picture is concerned, it would be very difficult for Zomato to compound at 15 to 20% CAGR rate for next 10 to 15 years because that would require massive profitability as discussed in our calculation. Majority of Zomato growth journey is enjoyed by early investors between 2010 to 2020. And the current valuation of Zomato already discount a good amount of future earning growth. That is my perspective. Now tell me in the comments, what do you think about Zomato? Are Zomato valuations justified? Can it continue to create wealth for the investor in the long term? And did I miss any key point? Let me know. If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.